Hi, everyone. Welcome to Triathlon Partners TV. This is Ira Coiner, and today we'll be going to be discussing the dynamics in the current equity market, as well as structured notes. I believe is a fantastic way to get involved in the market right now at the current level. Now, we all know the S&P 500 is up 27% this year, and 5% of that is after the U.S. presidential election. Right? And we know historically, the year after a presidential election, on average, that year's performance is greater than a typical year's performance. A lot of people want to get involved and be involved to get those returns for next year, which on average do perform better than a typical year. But they are concerned at current levels. Now, we have a solution, and it's called structured notes. Structured notes are fantastic because they can provide protection when the market goes down. They can provide permanent protection, 100% of your principal. They can provide permanent protection of the first 30% loss. They can provide protection that only provides protection if the market's down a certain amount. If it's down more, you lose as if you were long the index. Still better than owning the index outright, owning the market outright, and being subject to 100% up and down loss. Structured notes are great because of that. They're great because they're long term, and you don't have to be concerned about the intermittent volatility over the next 3 to 5 years, because you just want to know where it's going to be in that 3 to 5 year period. And if you're a long-term equity investor, that's what's important, right? As well as these products have a participation multiplier. That means if the market goes up, you don't get a one-to-one return on the market. You can get between a 1.4 and a 2.3 multiplier, participation multiplier if the market goes up. So in mathematical terms, the market's up 10%, you're up 14%. Or if the market's up 10% and you have a 2.2 multiplier, you're up 23%. This is providing a lot of extra value to our clients. Now, this sounds great, and I could throw out multipliers all day long with protection. And if you don't understand what the underlying product is, fuck it, doesn't mean anything. So now we're going to go into the product that is involved in these structured notes. It's called the S&P 500, the S&P Futures 500 Excess Return Index. What that means in a nutshell is you involved in invest in the S&P 500. It has this average. Forms is great. But you do know you had an alternative. Your alternative was to invest in fixed income, in the government bonds. And government bonds don't have any risk. We assume that the government is going to pay back 100% of the bond's principal and interest. Great. So the bonds right now earning 4.25, and you can earn 1.25 on the dividend in the equity market. Those bonds are providing a 3% guaranteed return greater than your equity investment. So your equity investment in the S&P 500 needs to perform more than that 3%, need to be even, but it also comes with a lot of volatility and risk. So even if you get that total 4.25% return on your equities, you're the same place money-wise as you were with the U.S. bonds, you took on a lot more risk. Something we don't want. We want you to make sure you're getting more returns, the same amount of risk, or less risk for the same amount of return. So with this excess return indexes, it takes that into account. Now, when we compare the S&P 500 to the S&P 500 Futures Excess Return, that excess return index is going to perform most likely worse than the S&P 500. Now I'm sitting here telling you to invest in this worst performing index. The reason why is because of the multiplier. If we would sort of say, hey, the S&P 500 is going to return 9% next year. But we have this excess return index. You know, it's really only that excess return index is only going to perform 6%. Why? Because you have 4.25% that the treasury is going to yield. You have 1.25% that the dividends are going to make. So that difference of 3% means you only excess. You're only making that extra return of 6%. Okay. Now, if you look into the product that we have, what are the participation? Well, participation multiplier. So it's one of them is 2.3%. Now, what's 2.3%? 2.3 times 2.3 times 6% is 13. That's 13.8% your return on the structured note versus 9% return on your S&P 500. Okay, so far the note looks great. The thing is, these notes are priced with this current environment of high interest rates, low dividends at that 3%. That's what makes the multiplier. But when we look at the current environment of U.S. interest rates, the Fed has inflation under control. They've been lowering rates. So that narrow, that 3%, it's narrowing. It could narrow to 2%. And let's say, for argument's sake, it narrows to 2%. You have the S&P 500 again at 9% return. The excess return index is just going to be 7%. 7% times 2.3, 14 plus. That is going to be, it's going to be 16.1% versus the 9. So we can see that over the long term, when this excess return of government bond rates and dividends, if we're at a higher point now, when that contracts, we still have that great multiplier, which was based on the old dynamic, right? So we have to use that to our advantage, and that's where strategic and smart investing happens. And guess who lives at that intersection? Triathlon Partners, and you can reach us at 475-241-4417, or please contact us on the web at our website, TriathlonPartners.com. Now, thank you very much for tuning in. We hope we just really provided some thought-provoking discussions on your end about what type of investments should I be going into in this new year that take advantage of the upside market, but yet give us protection on the downside. And as you've seen before with all our episode structures, those are a big part of our investment plan. We do believe a substantial amount, a significant amount of the portfolio should be put in there. Really depends upon your individual risk profile and financial objectives. So thank you very much for tuning in, and please, we love our stuff. The subscribers, thumbs up, friends and followers on social media. It's great. We appreciate everything you do to help us out. And again, contact us with your questions, because we know we can make a difference in your financial objectives. Have a blessed day, and please stay tuned. We're going to share with you the disclaimers and disclosures. You know, they're everyone's favorite parts, and they're certainly online. All right, everyone, have a very blessed day.